All right, let's jump right into it. Today, we are doing a deep dive due diligence explainer on GlobalFoundries, ticker symbol GFS. We're going to unpack their Q1 2026 earnings, explore this really unique geopolitical positioning they have, and break down the current market sentiment. And we're using verified data straight from their SEC filings, the Motley Fool, Benzinga, and Counterpoint Research to do it. Look, if you've been tracking the semiconductor space at all lately, you know it's a rapidly shifting landscape, and GlobalFoundries is making some highly strategic moves right now that absolutely warrant a closer look.
To keep things organized, here is our roadmap for today's explainer. We'll be moving through their industry position and market share, their geopolitical and innovation moat, financial health and revenue, dividends and shareholder returns, and finally, analyst ratings and sentiment. Okay, let's kick things off with Section 1, Industry Position and Market Share.
Looking at this Counterpoint research data for the first quarter of 2026, it's pretty wild to see that the pure-play foundry sector actually grew 30% year over year. That is heavily driven by this massive wave of AI and ASIC orders. Now, obviously, it is no secret that TSMC is the absolute giant in the room here, capturing a massive 73% of the market. But right there, holding down a critical 3% slice of this fast-growing pie, is GlobalFoundries. Now, I know 3% might sound kind of small at first glance, but in a heavily capital-intensive, high-barrier-to-entry market like semiconductor manufacturing, that is a highly strategic, incredibly valuable foothold. But here is the real kicker, and the thing that truly differentiates them. According to reports from the National Institute of Standards and Technology, GlobalFoundries is the only mature foundry at scale headquartered in the United States, which provides a completely critical alternative outside of China. We are living in a world right now where supply chain regionalization is literally a top priority for global governments and massive international corporations. So having this US base, that's not just a neat piece of trivia, it is a massive core value proposition for the company. Which leads us perfectly into Section 2, the geopolitical and innovation moat. Because you can't just rely on where your headquarters is located, you need the actual tech to back it up.
And they are doing just that. The company is successfully pivoting from being a generic legacy foundry into a highly specialized powerhouse. For example, they are heavily focused on silicon photonics, which they project is going to double by 2026, and they are aiming for a $1 billion annual run rate by the end of 2028. They're also dominating in silicon germanium for AI data center networking. Think of it like they are building the physical high-speed highways that allow AI to run as fast as it does. Plus, on the bleeding edge of tech, they are actually establishing a secure U.S. quantum manufacturing base, and that is supported by a $375 million intent to award from the U.S. Department of Commerce. This is exactly how they're embedding themselves deep into the next generation of computing.
And you can see the market responding to this. Just listen to this quote from CEO Tim Bream during their Q1 earnings call. He noted a 50% increase in design wins compared to the same time last year. That is an absolutely vital metric. In the foundry business, your design wins today are the leading indicator for your revenue tapeouts tomorrow. It essentially means that customers are locking themselves in with GlobalFoundries for their upcoming product cycles right now. And this U.S. onshoring angle is pulling in some massive partnerships. We are talking about a multi-billion-dollar expansion with Japan's Renesas across a bunch of different tech platforms, early capeouts for Apple over at their Malta, New York fab, and deep collaborations with quantum innovators like Dirac and Equal One. They're locking in these incredibly deep engagements throughout their customers' R&D cycles, which makes their foundry services incredibly sticky in the long run. All right, let's talk numbers. Section 3, Financial Health and Revenue. Let's see how all this strategy actually translates into dollars and cents. They delivered a really solid quarter, beating expectations with $1.634 billion in total revenue, up 3.1% year over year. But the absolute standout on this table is that 29% gross margin. That is a 510 basis point jump, meaning a 5.1% increase from the previous year. That's huge. It's their largest margin expansion in over 3 years. Net income rose to $227 million, and their diluted earnings per share hit 40 cents, which came in right at the high end of their own guidance. So where is this cash actually coming from? Well, their revenue mix is fundamentally shifting. Automotive is now sitting at 23%, and data center revenues are at 14%, and both are surging. In fact, they hit a company record this quarter where 2/3 of their total revenue came from outside of the traditional smart mobile device market. They are successfully diversifying into higher margin, secular growth areas, which is exactly what you want to see. We also have to highlight their sector split here because this is super interesting. While core manufacturing services obviously make up the bulk at 87% of revenue, their technology services sector really outperformed expectations to hit 13%. This was significantly boosted by integrating their recent acquisition of MIPS, which is a leading supplier of AI and processor IP. Basically, this technology services segment adds a really nice, high-margin layer of software and intellectual property revenue right on top of their physical wafer production.
So, what does this mean for investors? Let's get into Section 4. Dividends and shareholder returns, because expanding profit margins naturally lead to cash in pockets. At their 2026 Investor Day, GlobalFoundries announced a pretty major milestone for a company, their first ever quarterly dividend. They declared 12 cents per share made payable in July 2026. Look, for a semiconductor foundry, which is historically an incredibly capital-intensive business, to initiate a dividend, that speaks volumes. It screams management confidence in their durable cash flow. And this dividend isn't just a random one-off thing. It's part of a brand new, highly structured capital allocation framework. The plan is simple but effective. Generate adjusted free cash flow, ensure all their internal capacity and R&D investments are fully funded first, and then target returning up to 50% of that remaining trailing 12-month cash flow straight back to investors through both dividends and share repurchases. And speaking of share repurchases, they have already been super aggressive here. They executed $400 million in share repurchases in Q1 alone, out of a $500 million authorization. And the reality is, they can easily afford to do this because they are backed by a fortress-like balance sheet, boasting a massive $3.8 billion cash and marketable securities position. Let's see what the pros think about all this. Section 5. Analyst ratings and sentiment. Reviewing the latest analyst reports compiled by Benzinga, we're seeing a pretty diverse range of price targets out there. You've got bullish outliers like Susquehanna maintaining a positive rating and leading the pack with a $125 price target. Then you have Evercore at 85 with an outperform rating. On the slightly more conservative side, firms like UBS and JP Morgan are maintaining neutral ratings with targets sitting in the 70 to 77 range. If we impartially look at the broader consensus of 15 analysts, the stock holds a generally neutral to buy rating overall. Breaking it down, that's 8 buys, 6 holds, and 1 sell. The average consensus price target sits at $63, which, at the time this data was pulled, implied roughly a 29% upside from current trading levels. So, generally speaking, Wall Street broadly sees the value here. They're just kind of debating exactly how high the ceiling is in the near term. Which brings us to our final thought for today. Given the escalating global demand for regionalized supply chains, their increasingly tight grip on specialized AI and quantum silicon, and this brand new commitment to shareholder returns, does this make GlobalFoundries the most critical semiconductor manufacturer in the U.S. today? It is a fascinating structural advantage that clearly separates them from the rest of the foundry pack. Thanks so much for joining me on this explainer, and definitely keep a close eye on how these geopolitical tailwinds continue to unfold for GFS.